Good afternoon, everybody. Hope everyone is well. If you can hear me, please give me a thumbs up. Good. Thank you very much. So I'd like to officially welcome everybody who's into this webinar today titled Alternative Funding Models Beyond Traditional Funding Sources. You're very welcome. My name is Esther Anyaga, Director and Co-founder at DhamiraNN Global Advisory. I am a resource mobilization and grants management expert, and on behalf of DhamiraNN Global Advisory, welcome. So I see people are coming in. This is very good. So I'd like for us to do a quick introduction on the chat, and then I will read out a few introductions, give someone a few minutes of fame. And this is how we're going to do it. We're going to state our name or your name, your organization, your country, and complete the sentence. If our funding strategy or vehicle, it would be. And then you could be a bicycle. If you're a bicycle, you're moving but with limited capacity. If you're a car, you're stable but still dependent on a few funding sources. If you're a bus, you're supported by several partners. If you're a rocket, you're diversified and ready to scale. And if you're still in the garage, you're building systems and strategy. So please go ahead in the chat. I'll drop the instructions on the chat. Please let's introduce ourselves, and then I'll pick on a few lucky people to unmute themselves and say hello. Pauline Lugalia, would you like to introduce yourself?
Sure. Good afternoon, good day, wherever you are. My name is Pauline Lugalia, consulting for two financial institutions. We are still at the garage. Thank you.
Thank you, Pauline. Let me see. Daniel, would you like to unmute yourself and introduce yourself, please? Thank you.
Thank you. I am Daniel Kimutai, and I work for Fund. Fund is a global organization in over 50 countries, and we are now venturing ourselves into this space of blended finance mechanisms. So, yeah, glad to be here. I work in Central African Republic. That's where I'm based, but I'm the regional program funding manager for Eastern Central Africa region. Thank you.
Thank you, Daniel. One last person, please, let's use the chat, drop your LinkedIn handle, network as we wait for everyone. Let me pick on Emily. Hi, Emily. How are you? Would you like to introduce yourself?
Hi, it's very early in the US, so I have to speak quietly. I'm an incoming MBA student at Harvard Business School, but this summer I'm working with Panorama Health, where they're based in Ghana. And I would say, I guess we're still a bicycle. I think that's all the questions. Thanks for hosting this webinar.
Thank you. Thank you so much. So let's continue introducing ourselves in the chats. Drop your LinkedIn handle, and I think we're officially ready to continue. One last person, Edmond. Do you like to introduce yourself, please?
Hello, can you hear me?
Yes.
Great, thanks so much. My name is Edmond Cordero. I work for an organization called Village Reach. Village Reach works with the governments within the Global South countries to build resilient health systems that can respond to public health shocks. I'm based off Nairobi, Kenya. And in terms of Village Reach as my employer, I think we are not off the garage yet. But if I were to look at my own personal consulting work here and there, I don't think I've even reached the garage. Probably I'm still parked at the backyard. Thank you.
I appreciate the honesty. I feel like that's the first step in the spirit of admitting the problem. But thank you, Edmund, for introducing yourselves. Welcome very much to this session. We'll continue introducing ourselves in the chat, but just a quick overview. The big question that we're trying to answer today is how can your organization leverage blended finance and impact investment to thrive in an evolving funding landscape? So the development sector is entering a financing transition. Grants remain essential, but they are no longer sufficient on their own. And this is something we'll be doing a deep dive into today to understand what the sector looks like and now how development actors can now adapt. So I'll do a quick introduction of DhamiraNN before I introduce my main moderator, and then we will start this conversation. So DhamiraNN is a global advisory firm advancing organizational impact through system strengthening, strategic resource mobilization, and capacity development. We support NGOs, CSOs, and social enterprises to improve fundraising performance, donor compliance, and overall organizational effectiveness. And we have 3 key services that we provide. Donor-ready system strengthening. So we provide strategic guidance to build efficient organizational systems and processes, compliance, accountability, reporting system to make sure that, when you're ready to go after that big grant, your system's actually ready for it. And then support with grants and resource mobilization. So end-to-end support across the RM cycle from opportunity identification to reporting, and then our capacity building wing, which is DhamiraNN Grants Right School, which provides practical hands-on training to build internal fundraising capacity. And on the next slide, you'll see our upcoming calendar. So this coming August, we're having a strategic resource mobilization for scaled impact. And also alternative funding models, leveraging blended finance for sustainable development. So this will be a continuation of the conversation that we've started today. So if you're interested in understanding how to, create a model for an organization to explore blended finance, this is a training for you. And then we'll also be having a strategic resource mobilization training specifically for senior leadership. And then October, we'll be having strategic resource mobilization for scaled impact and leveraging blended finance. And then in November, we'll be talking about social enterprises for NGOs and how you can build your domestic resource mobilization capacity. Enough about DhamiraNN. So we've organized this conversation today because, as I said, the development financing landscape is changing rapidly. Organizations are being challenged to think more strategically about blended finance, impact investments, and income partnerships and other approaches that can really help them to sustain and scale their impact. And today's discussion is designed to move beyond theory, and our panelists will be sharing very practical insights as to what blended finance and impact investment looks like in practice, what makes an organization ready, and how development actors can position themselves to access alternative forms of capital without compromising their mission. So a few housekeeping rules before we start it off. So the session will be recorded. You can already see a prompt at the top, and the slides will be shared after the webinar with the emails you signed up with. And then please keep your microphones muted unless invited to speak. Use the chat function to share your reflections and questions throughout the discussion. We have a dedicated question and answer sessions at the end, so please feel free to drop your question in the Q&A area or on the chat, and we will consolidate them, and our panelists will respond to them at the end. Right now, I'd like to pass the mantle over to Chilande Kuloba. I will read a short introduction of her, and then I will let her take over from there, and she will, take these. I think we are bus, maybe. So Chilande Kuloba Waria is the founder and managing director of Warande Advisory Foundation, and will be sharing her LinkedIn link on the chat. This is a Kenya-based organization working across Africa to strengthen civil society organizations, build coalitions, and reshape how the development funding reaches local actors. With over 20 years of experience, she works closely with philanthropy, intermediaries, and grassroots organizations to translate commitments to locally led development into practical, actionable systems. Chilande is also a co-founder of the Local Coalition Accelerator, which is a multi-country initiative supporting locally led coalitions to design and deliver community-driven solutions at scale, and the Philanthropy Dialogues, an initiative that is looking to design prototypes for real systemic change. You'll be seeing on our presentation the other people that panelists that are here today. But I know Chilande will be doing a detailed introduction of them shortly. So Chilande, over to you if you can hear me.
Yes, can you hear me?
Yes.
Fantastic. Thank you, Esther. I love that you're on this bus, and I'm hoping that the bus becomes a jet by the time we are done with this conversation. Good afternoon and good morning. And, I'm not sure if there's anybody who should be going to sleep now, but if you are, good night to you. Thank you so much for inviting me into this conversation, and thank you to everybody who's taken the time. Time these days is a lot more precious, so we don't take it for granted that you're here. Mine is just to be a moderator, so I'll chip in where I can, but we have a fantastic panel here to help us with this conversation that is just incredibly, incredibly timely, because we are really at a moment where all the assumptions that we made around, especially around development financing for decades, no longer hold. If I remember back in the day when I started, and I'm not telling you exactly when so that you don't calculate my age, when we started doing some of this fundraising, it was simple. Find a donor, respond to a call, receive a grant, implement your project, report. Hopefully you renew. But now with this, the way things have changed, and somebody challenged me the other day saying, the aid budgets are not really shrinking, they're just shifting. Africa is no longer it, right? So folks like the Yemeni and Iran and all those different places will say something different. Basically, donor priorities have changed, and now we are seeing shorter funding horizons for a lot of us, increased competition. There was already competition from back in the day, and now it's even more, fragile, the state that we're operating. So perhaps right now what we're thinking about is not necessarily where will our next grant come from, but perhaps, what kind of institutions are we building, which is why I'm excited about some of the, the diversity of the panelists. What kind of institutions are we building, and how will this institution therefore be financed over time? I also, really want to challenge us, as right now we are thinking about, diversify. It doesn't necessarily always mean that moving from 5 donors to 10 donors. It will diversify your funding base, but it doesn't necessarily mean that your financing model will help you towards your resilience or sustainability. So today we're going to talk about a much broader financing ecosystem, ideas, big words like, blended finance and impact investment, catalytic capital, local philanthropy, community finance, all of that good stuff, depending on what is represented here today. But I really hope that we have a very healthy, honest conversation. We've asked those who are contributing, who are leading us with their contributions, to be as honest, but also as practical as possible. But also keeping in mind, even as these ideas come out, is that not every organization needs to become a social enterprise. So let's give ourselves grace. Not every social problem is investable, right? I don't know if that's a word. And not every form of capital is appropriate for every mission. So listen to all of this and interrogate and ask questions to see whether you're a good fit. The real strategic question here is, which capital fits my purpose, and how does my organization create value for myself, for our communities, but also for where this funding is coming from. So we're going to try and keep this very practical, and see. I'd welcome you to participate on the chats as we go along, as a thought pops into your head or an idea comes to mind, but also put the Q&As for the more formal responses. Right. So I can talk quite a bit, but today is not about me. We have a very diverse group of folks here with us today, where we've got, Evans, for example. Evans is coming in from Zambia, and Evans, every time people from your area see my name Chilande, they think I'm from there, but I'm very much Kenyan. Just putting it out there right now so that I manage that expectation.
I thought so. I thought you are from Zambia, my relative.
Evans is a resource mobilization, partnerships, and development finance expert with over 8 years of experience supporting NGOs and social impact organizations across Africa. His work really spans blended finance, impact investment, and sustainable financing models, and he has contributed to more than 10 million US dollars in funding opportunities through partnerships with major bilaterals and multilateral institutions. Evans also leads EMARS, my tongue, consultancy and research firm, and he brings a strong interest in helping development organizations move beyond the traditional funding models, but really looking at their infrastructure. So we are very excited to have you bring in this development finance lens here. We also have, from those across the lake, we still believe the water and the land mass is ours, from Uganda, Philippa Elite. I'm sure you'll say your name properly, but at least I can say Philippa Elite. I'm not so sure if I got it right, but we'll give it a try. Our sister from across the lake. She's an investment and enterprise development professional with over 6 years of experience, helping SMEs and social enterprises become investment ready and access growth financing. She has worked across agriculture, clean energy, green enterprise, supporting businesses to strengthen their financial systems, strategies, and positioning for investment. Philippa brings practical experience in connecting enterprises to blended finance and impact investment opportunities. So, she's much closer to the investment readiness side, entrepreneurship, thinking more business. These days, we are always told just because you're in the development sector and they give us the term non-profit doesn't mean we can't make a profit. So it's good to have that lens on us, in the room. Last but not least, we've got Pamela, who's right here from here in Kenya. And she's a resource mobilization and fundraising expert with over 11 years of experience across the development, private and consultancy sectors. She has contributed to more than 50 million USD in successful country and regional funding awards, and brings extensive experience in institutional fundraising, partnerships, and financing across climate, agriculture, health, and economic empowerment. Pamela is the director at DhamiraNN Global Advisory, where she supports organizations to strengthen their fundraising capacity and unlock sustainable financing. So she's been doing the actual tinkering, fixing of things. So we very much welcome her perspective to the table. So those are my three specialists in this area and three perspectives. But let's dive right into the conversation at hand. And I want to start off, I've just introduced all three of you with your different lenses. And I want us to start off with, what is the financing reality that you are navigating from your vantage point, from your point of view? I think I want to hear a little bit, just give us some insights on how does this look like from your experience? What are the major shifts that you're seeing in how development is being financed today? I want to start. Let me start with you, Pamela, because you're right there at the front, and then I'll come to you, Philippa, and then end up with you, Evans. No bias.
Thank you so much, Chilande. And I can attest 10 years ago, I don't want you to also count my years, but 10 years ago, the space was quite lucrative. You could search for opportunities, grants were available, US aid was booming. The reality right now is quite interesting because it's very difficult to get the grants as we could get 10 years or 15 years ago. So, as you know, there's a 4 trillion, they say there's a 4 trillion funding gap in the sector. That means there are so many areas that are not being funded as they used to be. A very simple case would be Kenya. USAID used to fund health very heavily. Right now, there's a huge gap in the health sector, the health development sector. Agriculture is another one that has a huge gap. It's very clear that governments, the existing philanthropic entities are not able to feed this gap. So the question is, who is going to fill in this gap? Is it the private sector We all know that the private sector is profit-driven, is revenue-driven. If you have an investment in the private sector, let's say a certain asset manager, their goal is to make sure that they bring in revenue. So really, they are not into the social impact side of things. So who is going to fund the core of the development sector? That's the question. So NGOs in this room, other players in this room have to figure out how do you receive funding, which is already very little, but also of the little that you receive, how do you maximize impact? So those are my parting shots. Back to you, Chilande. Thank you.
Absolutely. Who's going to come in? We're always waiting for a savior to come in, but I'm hoping by the end of this, we will figure out how we do this on our own. So over to you, Philippa. What does it look like from your end?
Yes, thank you so much, Chilande, and good afternoon and good morning to all the members in this webinar. So from my experience of this ecosystem currently, before, as you had mentioned, and also Pamela had mentioned, we had specific stakeholders. So it was either the government or, international NGOs that were funding, looking for the problem, the developmental problem, and they would fund, right, through grants for a period of 2 years or 3 years. But you see that currently in the ecosystem, we have an enormous number of stakeholders that are emerging. You see, we currently have impact investors that are present. We have, the commercial funders. These now are the banks. We have the blended finance institutions. We have the philanthropy institutions that are coming in. So these newer stakeholders are not following the models, the grant model that we previously used, to sort out the developmental problems that we're facing. So currently they are shifting, Besides the grant, how sustainable is your enterprise? If we have given you this grant investment for 2-3 years and we leave, or we shift, or cut out investment, are you going to be a sustainable enterprise, right? Those are the questions these other stakeholders are asking. So as enterprises, we need to shift away from, looking out for the grant-ready grant investments, and also look at, the debt funding, the loan financing, because even with this grant funding, it's not able, the money that is currently in place for the grants is not enough for us to actually sort out the major, challenges, issues that we are facing as a region, if I may give a case of sub-Saharan Africa, So you need to look beyond, we need to look beyond the grant funding. And that is why these different stakeholders are introducing new structures that can help us unlock the capital that is in circulation, right? Just as Pamela had mentioned, but is still, not being disbursed. So you're finding a lot of blended finance stakeholders coming in, first loss institutions coming in, so that we can de-risk investments in our ecosystem and then unlock the financing. Thank you very much.
Thank you. Wow, so many new big buzzwords you put out there, and hopefully we can dive into as many as we can, and then there'll be continuation. I'm sure we don't have enough time to go into it. But Evans, I want to hear from your perspective. What does that look like for you, who's deep in the development financing world?
Thank you so much. One thing we have to understand, I think, like Pamela indicated, 10 years ago, there was unrestricted funding. The donor would just come and ask you to say, there is money here. Can you do a proposal? Whether the proposal is competitive or not, they didn't care. They'll give you the money. But this time things have changed. Even if the call comes, you find that maybe there are over 50 applications which have been submitted. And the same money, once they come to organization, there is restrictions to that money which is coming. So the aid-based development has shifted now, has moved to now what they're saying, investment kind of aid or development which they're giving. So I find that because of this, how do now organization position themselves? How do we continue making impact? Because remember, once these things are coming in, there is an effect also to the communities. Communities are being affected. And the same organization who employ people are also affected. So there are so many debates which are coming in because of this and that. So the major issue for me is that restricted funding is what is there now, and restricted funding has gone down. Like if you look at the book at Who Moved My Chairs. So where is the money? Has the money moved, or there's still money, but just the priority which has moved? So that are the things we have to consider. If there is still money, where is the money? Or who is keeping the money? Who's going to fund? Because before then, there was government who are implementing. They came NGOs. But again, we are moving from NGOs because the NGOs, they don't have money. How do they continue? I think for me, that's what I can say for now. Thank you.
You have said so many things that make me want to talk for another 1 hour, but I'll keep my thoughts to myself. But yeah, I think the only other opportunity I know that we haven't really mentioned too much of is the growing. I don't know if some of you have seen the statistics, but diaspora remittances are phenomenal. Like they are way more than philanthropy giving, even bigger than ODA, and bigger than some of these other types of funding. So that's also some ideas, but I suspect that a lot of them are going the route that Philippa is mentioning of also looking at it from an investment perspective. Their mindset is also slightly changing. So things for us to consider: where is the money? So I'm going to come back to you, Pamela, to something that has been mentioned and been alluded, and the big word over here. Can you break down for us, just, especially if you can use a case study, if possible, to help us understand this big buzzword that we are all now talking about? What in goodness name is blended finance truly? What does it actually mean?
Let me take you through this slide. I hope I will not lose some of you in the buzzwords, right? So blended finance is not a new thing. It has been existing. And it is not a new funding source, because some of you might think it's the new flashy thing. But blended finance is combining grants. If you have an existing grant from a donor who is a philanthropic donor, you match it with private capital, right? It could be a loan. You had Philippa mentioning equity. When you mix the two, that's now blended finance. So why do we have blended finance? Blended finance is done to de-risk. Philippa said the word de-risk. De-risk means that the private sector is not attracted to working in the development impact, social kind of things. How do you now attract the private sector to come in and invest in development ideas or in development programs? So you de-risk the private sector for them to enter into these previously unattractive sectors. I'll give an example. In agriculture, there's no private sector player who would want to go and work with smallholder farmers whose incomes are quite low. But a grant will come in, train the smallholder farmers. The private sector will come in, invest in the smallholder farmers. Let's say they are giving them threshing machines. The grant will come in to de-risk, give it at a loan which is subsidized. If the market rate for these threshers is at 15%, the de-risking element would be that the grant will come in and reduce it to, let's say, 2%. The farmer pays it at a subsidized rate. Another sector would be solar. Solar is not a lucrative area for private sector. But a grant, let's say the GEF or the GCF, these are like climate funding philanthropic entities and MDBs, would come in, de-risk the solar panels or the solar lamps, so that we are now getting into that kind of market, which is previously not lucrative. So this is a summary. There are 3 types of blended finance. I hope I'm not taking too much time, Chilande, but this will give a good setting. All right. So Concessional capital. Concessional capital is providing below market rates instruments, and they absorb higher risks to improve the risk return profile. So here you had Philippa mentioning fast loss. Fast loss is an example of a concessional capital because it absorbs the initial losses that will now attract more investors into that kind of profile. Another example is a guarantee. I'm sure you've heard of guarantees from the banks. But in the development sector, when we talk about guarantees, we simply mean that you're reducing the investor downside risk, right? So here we talk about mechanisms where the public or the philanthropic entities promise to cover specific losses. You'll hear an example where 50%, let's say World Bank or the IFC, they get into an agreement where they agree to absorb 50% in case of default of loans. So you'll go to a certain bank and here they have a guarantee. I'll give a case example, a case study. Agriculture has so many guarantees. An example would be the Africa Guarantee Fund. In majority of the banks, if you go there, they'll tell you, we have an agriculture guarantee. 50% is backed up by Agriculture Guarantee Fund. So in case of default by a certain agri-SME, we are sorted. You see, now this attracts the private sector into that kind of sector. The final one, which majority of you know, is grants and TA. TA are capacity building blended finance. So we have the grant. It gives the SMEs capacity to have the capacity to be investor ready. And Philippa is the expert in this. So TA, technical assistance, can include trainings, capacity building, BDS. I'm sure you've heard of BDS, Business Development Services. It can even include ESG trainings. How as an organization can you meet environmental and social governance reporting so that you're investor attractive? You're beautiful to an investor when you're meeting gender mainstreaming, ESG, financial, your books are in good condition. So that's the grants and TA. I hope I haven't made it too technical, but in summary, that is what is blended finance. Over to you, Chilande.
Thank you, Pamela. I don't know about the rest, but you've broken down for me things, some things, it's solidifying some more. Every time I hear it, I'm like, aha, got it. And lots of other new thoughts and ideas. And you've made it actually sound possible. So thank you for breaking it down for us. I'm going to move on to you, Philip. And I know there's time and I know there's more ideas you could give us around that, but I want to move slightly forward and zero in on this one area also that is a huge mystery, but many of us are thinking about it, and Pamela already spotlighted that this is an area you're particularly comfortable with. The term impact investing. If you could break down for us just a little bit more, although we've had quite a bit what it is, but more importantly, what does it take to be investments ready from this perspective?
Thank you, Chilande. So just to complement what Pamela said, impact investment is a broader term also. Blended finance is a specific component of impact investment. So when an investor is coming in to fund, these impact investors would be interested in understanding what social impact, or following the ESG components, is the enterprise also putting into consideration besides their capital raise. So let me give an example of an agribusiness, an agricultural business. So this enterprise states that they are looking to raise capital, probably for machinery or working capital. So an impact investor would want to know, all right, besides, the money, the revenues that you've been making, what other ESG components, these are the environmental, economic, and social components are you considering? So this person is going to structure his profile or his engagement with the impact investor by, talking about how he has trained his farmer base, how he has improved the livelihoods of his suppliers. Another example can be if he has introduced, climate smart agriculture practices into his agribusiness, So an impact investor would be interested in understanding such components besides the financial bit. So now the mismatch currently is that most of our enterprises understand, they understand the ESG components. We understand the impact that we are supposed to be tracking. But beyond that, when that said investor comes in to do his due diligence, he finds that most of the enterprises have not integrated impact into the systems, into our operations, into our daily operations. And now that's where the challenge comes in. For an enterprise that is looking to raise capital from impact investors, one of the major components or factors that this said investor would be interested in is in understanding your governance. Who is controlling the organization and what is happening? What will happen when the founder, let's say, falls sick, right? They are looking for sustainability in your business model. So they look for how functional your board is, right? They'll look for what is the mode of decision making in the enterprise, conflicts of interest. Do you have relatives or close partners in the institute, but do you have controlling systems that ensure that your financial management is traceable? If this person is coming in to trace how you've used how you've operated in, let's say, 2025, is it transparent that this person will track from January 2025 until December and will understand your entire business model? Also, another component that this impact investor would look out for is for your organogram, right? Do you have a functional organogram with all your employees in the organization understanding their roles and, following that JD to the dot, or each person is, just running the show just like that, right? Another critical factor that has also affected our enterprises from raising capital is the key man risk. For an impact investor, he would come in and portray the business as a risky enterprise because the director is the key decision maker. For an ideal impact investment potential enterprise, they would want to know what are the levels of, decision making. It shouldn't be confined in one individual. Another critical area this impact investor would look out for are of course, the financial systems. As I had mentioned, besides the impact that they're also very critical about is the financial management, right? Are these enterprises auditing their accounts, right? Are your cash flows visible to an outsider? Let's say if this impact investor brought in an external auditor, would you as an enterprise justify each expense you've incurred in the organization or each use of your cash flows or your money in the organization, right? Working capital constraints, right? How are you using your money in the organization? How are you, getting your receivables from your off-takers? How are you managing your relationships with your off-takers? How are you managing the relationships with your suppliers, right? Those are some of the areas that an impact investor would want to look and understand. Also, another component that they would be very critical about is the leadership maturity. You know, one of the challenges that most of these investors face with our African, enterprises is that you will find a very good business model, a very good director hiring someone who doesn't have the skill set to run that department, right? Simply because maybe they are their relative, they are their close friend, partner, but this person is not able to run the specific department, right? So you find challenges of mismanagement, uh, and for in the lens of an investor, that would be a risky area. So that those are some of the components that have really affected our enterprises from raising capital from impact investors. Another very critical factor for them is the impact measurement. As much as we have impact in our enterprises, we are not documenting that information, right? For the impact investors. And for them, they would be very critical to understand, okay, you've said you've trained farmers. Can we see, the farmer registration lists? Can we see the pictorials? Can we see, the changes that were made after these trainings? We are not documenting that information, and yet we can leverage that information to actually raise capital from these different impact investors. So as enterprises, it's very critical for us to document all the processes in our organizations so that we can use it to unlock capital. Thank you.
Thank
Chilande.
you. Oh, wow. That's quite some, breakdown for us, Philippa. Thank you so much. Hopefully there is like some checklist that at some point people can have access to. They can start, and then they call on you to work with them on that journey to try and get themselves impact ready. Colleagues, I see time is going, but it's just, it's just such rich information that is being downloaded on us. If you ask me, because we took a little bit of time allowing rewarding the latecomers, if you allow me to take just no more between 5 to 10 minutes extra, please, so that we can get a little bit of the information in, but also take your questions. I just want to move real quick to Evans, because we've had quite a bit. We've had, these two big terminologies broken down for us, very concisely. And now we've had what we need to do internally as organizations to start trying to situate ourselves to receive this money. And I just wanted, from your vantage point, Evans, how does an organization strategically position themselves within this ecosystem to try and access some of this funding, or maybe even just influence some of its outcomes towards accessing more of these funds? Just, more from an external point of view, what would you say would be some of the key things organizations should look at so that we're in front of the right people?
Thank you so much. Thank you so much. Like Philip has indicated, let me just mention one thing about impact investment. You see that the reason why they're emphasizing on the impact investment is because you find that donors have been funding these communities years and years, but there's no change in the communities. The same farmers who were given the input 5 years ago are the same farmers receiving up to now. So you find that donors are saying these are not ready, market ready, because a farmer, once you give them input to this year, next year they should be able to grow and supply to the market so that they're able now to sustain themselves, of which is not happening. So now let's look at now the organization. How can organization leverage on this or be able to build their capacity so that they're able to tap into the investment? Because money is there. It's just that it has moved to another side of things. One, let's just look at our governance structures. Let's look at what are we doing internally as an organization? How are we delivering our programs? Those are the things we have to look at. How are services being done? How is the partnership kind of? How are we partnering with the private sector? Those are the things we have to look at. How we evidence are we in providing the impact? Because we've been implementing these programs. So it's about providing evidence to say we train the farmers, for example, and once we train the farmers, these were the outcomes, which are very verifiable outcomes. So that when I go in the community, I'll be able to see change, to say for farmers, for sure, these 10 farmers were doing this and this last year, but now they're market ready, they're able to sustain themselves. Are we able to build the market for the farmers? Are we linking the farmers to the market? Because there's an issue of also linking them to the market. That's why private sector will come in when they know that there is money. If there's no money, private sector will not even come in. They will say, why should we invest in there? Because they're looking at making a profit. So those are some of the things we have to look at. One, we have to look at, are we evidence-based partner? Are we building the market? Are we a market builder? How is our systems? How are we partnering? How is the partnership with the private sector? Are we able to provide evidence to what we do? What is the outcome of our programs? How are we delivering our programs? What are the solutions? Those are the things I think I can mention for now. Thank you so much.
Thank you so much. Pamela, you look like you're raring to go. So maybe I can throw this last question to you to see, like, because you do this firsthand, what does resource mobilization look like in blended finance and impact financing, and how can organizations balance financial sustainability but still remaining mission driven? Because we've had of mission creeps, people jumping to where the monies are. What thoughts do you have for us?
Thank you so much, Chilande. So this question is, I would say, a foundational question to help in the fundraising strategy. And it builds on the strategic positioning. Because the first question is, what kind of blended finance would your specific organization fit? There are sectors, I don't think we gave a proper background of sectors. There are sectors that fit perfectly for blended finance. An example would be energy, specifically mostly renewable energy, right? Renewable energy is able to match grants and private capital into one. Another sector that works very well is agriculture. You've had several references to agriculture, and you'll realize that sectors that work very well in blended finance are any sectors that have a revenue angle. So they are like humanitarian, pure humanitarian emergency response organizations will struggle a bit in blended finance because there's no direct revenue angle, right? I'll give an example of education. Like basic education doesn't have an angle to blended finance, but we have existing facilities that have been able, for some reason, to bring in blended finance because education has a revenue angle when worked in private sector. Health is another tricky one where organizations will not purely fit into blended finance, but still there are sections of health that are able to have blended finance, like health infrastructure, right? You've heard of governments working with, let's say, World Bank or AFDB. They have received infrastructure in counties. So health has an element of blended finance. So the first thing that in resource mobilization is figure out your organization, which sector does it work in, and what are the opportunities for blending finance. If there is no opportunity for revenue creation or anything that touches on private sector, it will be difficult. So in resource mobilization, step one, figure out what section of your organization can have that angle. The next thing, the big question in resource mobilization is partnerships. If you're able to unlock or invest heavily in partnership development, such that in each of, we haven't shown you the map of blended finance. It has distinct players that must be present. DFIs or MDBs, those are the World Banks, the AFDBs, the IFCs. The banking sector is another key player. So have you formed relationships with the financial institutions? If you're a small organization, you will not have done partnership agreements with big banks. It can be your local MFIs. This could be the microfinance institutions, the SACCOs, any form of financial is a key player in partnerships. And of course, the grant side, the donors. Who are your core donors? Make sure that you're able to map out your core partners. You have a good relationship. And over time, a grant-funded program is the one that matures into a blended finance. I'll give an example. If let's say the Rockefeller Foundation gave you a grant, I'll give the example Evans gave. They've been giving inputs to smallholder farmers in a certain country. They have done it for 10, 20 years. Rockefeller has been pumping in grant money. But you'll realize they recently launched a new strategy. IKEA as well. They are now shifting away from giving you grants. How do you figure out? They have been giving me money for 10 years, purely grants, giving fertilizers, giving seeds, which is free. Now, how do I shift my beneficiaries to now start thinking of the commercial side of things? So the other point of resource mobilization is graduate your current grant-funded programs into investable pieces that you can now do blended finance. Over to you, Chilande.
Looks like we need you guys, all three of you, for the different specializations. I'm going to pause. I know there's just a little bit of time left. Let me see if are there any questions from the audience. Let me give us a minute. There's a lot, and I'm enjoying the conversation, so I don't want to monopolize. Let me give a chance. Perhaps we can put down the slides so we can see each other and see if anybody has a thought, an idea, an example, any insights into what has been presented so generously to us today. I see lots of people here who I know have a wealth of experience. I don't want to volunteer you. You know yourself. There are some people that I've looked up to for quite a while, whom I'm seeing on here. I'm glad to see some names I know. Unless they have hung up their coats and moved away. Any thoughts? Please share with us your experience or your thoughts or your insights on what has been discussed before I ask our panelists for their final parting shots. Any thoughts? I have never known, for example, my brother Mike Mushilwa to not have a thought. I'm surprised he's quiet, and you know he has done remarkably well for the sector, setting up the Kenya Association of Fundraising Professionals. Let me do a plug, that trained a lot of us in some of these things and pioneered a lot of these ideas that are being presented now. I would be remiss if we didn't hear your voice, Mike. Sorry, now I know you, so now you're in trouble.
Hi, Waria. Can you hear me?
Yes, Mike.
Yeah, so very interesting discussion. And I'm someone who's been interested in social enterprise since the mid-90s, when donors would not even touch it. And in my history in consultancy and resource mobilization, I've seen many opportunities for generating income. And I think it was Pamela who was talking about looking for income streams. Most organizations have them. And I think the biggest enemy from my experience has been within. People who fight those who want to create income, a culture that is geared towards grants and easy money and allowances and workshops, rather than really getting and generating resources from the work that you do. KFP that you mentioned, Kenya Association of Fundraising Professionals, has never taken donor money. Since 2004, it's fully sustainable. An organization I've done a lot of work with. I mean, we did the donor thing from the 90s until 2004. Then 2005, we just went purely social enterprise. We financed it from our pockets. And it's never lost money. It has a surplus. It has its own. So we haven't gone to the point of going out to look for other investors. Because I've also seen, looking at, I hope this is not thing, but if you look at Twigger Foods, again, brilliant idea. That space they got into is a big, big headache for farmers. But I think, in my humble opinion, Yeah, the other point that comes in when you're looking at blended finance is when you have people, yes, coming to invest, but they're bringing such heavy overheads that this enterprise cannot absorb corporate overheads at that level. Yeah, they're just too heavy. Yeah, that has been one aspect of it. Yeah, but essentially, then I'm beginning to ask myself whether many of the NGOs would be able to transition into what is a business space. Social enterprise is actually business, because not lack of opportunities, but it's the way we think, the cultures we built within our organizations, the relationships, cultures, mindsets we've set with our beneficiaries out there in the field. Yeah. And business builds wealth. Let me end by saying, like, when you look at Safaricom and M-Pesa, what happens when M-Pesa stops working for a day? Then you realize how much development businesses can do. So thanks, Waria. Let me stop there. You know, I can talk forever. Let me stop there.
I had to trigger you. There was no way you were going away without giving us some of those thoughts. Thank you for sharing. And now maybe turning quickly. I'm over enjoying myself. Esther, please, with the questions, if there's any questions on there, don't let me go on as well. I can't see the chats, or else I will I'll lose my screen.
No
So in
problem.
case there's any questions, yeah.
Yeah, I think we have a question from Daniel. He's asking, are we seeing a genuine donor-led evolution away from traditional grants, or is the pivot toward blended finance actually an NGO-driven survival mechanism? Daniel, do you want to mute yourself and ask your question? Over to you.
Could you put
Thank you so much.
the screen? Just take off the PowerPoint so that we just have a conversation. Yeah. Sorry, go ahead.
Okay, thank you so much, and glad to hear Mike speaking. I'm happy that he's here. Good friend of mine, of course. He's a mentor in this industry. He has mentored some of us for many years. So my question really is on now. My experience has traditionally been in the INGO sector for many years. And what I'm asking here is whether the INGOs are shifting to the blended finance space because their traditional donors, the likes of FCDO, the likes of European Commission, the ECOs of this world and so forth, whether they are following where their traditional donors are going, or we are just shifting to the blended finance, in which you have clearly elaborated that this is not a new space, it has been there. So are we trying to fit ourselves into spaces where others have been because our sector is shrinking? I think that's the question. That is it NGOs who are like, they don't know what to do because the funding is no longer there in our institutional donors. Now we are shifting to new spaces, leaving behind our traditional donors with their little money, or are we moving together? And I think someone already mentioned two examples of Rockefeller there, and also I think IKEA Foundation. Those are two examples I've had. But I'm keen to hear whether we have these big institutional donors or multilateral donors who are also like changing the strategy completely, their funding mechanisms completely into blended finance. I hope I'm clear.
Yeah. Are we shifting to this model? Simply put, are we shifting because we see the value, we see the need, or are we shifting because money is gone? Any thoughts?
Let me try.
Mhm.
Not necessarily that money is gone. I think one thing we have to understand is that the donors now, they are fatigued. They have realized to say there's no much change in the communities where we're serving. So wow, based, because one of the models of blended finance is result based kind of, where they pay you after you have implemented, and then what is the results? If you fail, you don't get your money. So it means you have implemented, but you haven't gotten the money. So the shiftings, because I think everyone now is realizing to say, I think we need impact in the communities we serve, in the people we serve, instead of people just coming in. Like Mr. Mike indicated to say, you find that You're doing the same things over and over and over and over, and then there's no change. So the shifting is because of we're looking for a change. How best can we see impact in the communities we serve? How best can we see change in the people we serve? It's because of that. That's why most of the donors now, I think, are realizing to say, let's shift now. Let's try to embrace this model, which has already been there. But let's try to embrace it and see how best it can be used for us to have impact in the communities we serve and the people who are serving. I think that's what I can say.
Absolutely.
Hello,
Thank you.
Chilande.
Yes, yes.
Yes, I would also like to compliment what Evans has talked about. I believe there are three factors that are also pushing our enterprises to shift, right? Of course, the grant funding space has drastically, reduced, right? It has declined. I was reading an OECD report that had mentioned that it has declined by 26% and an additional 11% in just 2026, right? With the space declining even more with the years to come. So of course, as an enterprise, you have to, shift your strategy to where the money is. And right now, these funders are looking for sustainable enterprises. But besides them also, doing the assessment, evaluation, and finding out that there's actually not much change that has happened in the communities, they are also trying to understand what contribution we can give as an enterprise, right? Besides them fully, investing in that developmental problem, what can we as an enterprise contribute, right? Another factor that I believe is also a major component or factor for, this investment, this space, is that most of the challenges, the problems that we are addressing right now cannot fully be funded by grants, right? They're larger than what the grant funders are willing to give out currently. So we need to look for different structures of how we can unlock that capital to now, sort out that challenge. So that's where these different structures like the blended finance, etc., come into play. Thank you.
Amazing. Thank you, Zena. And wait, I asked for 10 extra minutes and I've been given 10 extra minutes, but I see there's quite a bit of chatter still. May I ask, okay, I see people are still here, but probably they'll start throwing daggers at us. May I ask the organizers that perhaps we can take these questions and maybe in sending back our thank yous, we can answer them on there. Is that fair to do? Because I'm a stickler for time. I don't like to take more than I asked for. Is that possible? But Pamela, go ahead.
There's one very good question from Elsie that I think we can take that as a final question, then we consider this a good session. Elsie, would you like to voice your question?
Yes, thank you. I actually asked 3 questions. I wish you'd indulge me on the 3 and maybe just have one package of answers.
We have the time.
Kindly. Thank you. So my question 1 is, let me just go back to it, allow me. Question 1, a lot of us NGOs, right now we're operating under very, very severe financial constraints. We have come down to only having core staff, operational budgets are not there, running projects have closed out, and so it is very, very constrained. So how do we still position ourselves, seeing that we are in between projects, to still come off as a credible organization, especially where financiers, donors would want to have organizations that have active presence? Question 1. Question 2, are there any financing that support organizations on institutional strengthening, especially at such a time in between projects, a very good time to concentrate a lot on institutional strengthening? Is there any financing for that, or that has to be tied to activities, or running projects? Are there those that really just focus on that, including pivoting, for example, to social enterprising? Third question, while there are many qualified resources, persons, consultants who can support organizations in this journey, they are very, very much expensive, prohibitive, especially at this current constrained kind of landscape that we are in. What are those low-cost approaches that we can still use so that we can rebuild, and develop sustainable funding systems? End of question. Thank you.
Wow. Who wants to take a stab at any of the questions? Let me see. Oh, I thought someone was speaking. So let me see the one I can quickly respond to. From what I know from my space is I know there is a couple of organizations that have specifically organizational strengthening budgets. So if you think about foundations like ISROF Foundation is 100% all about funding and supporting capacity improvement. Folks like Ford Foundation have got pockets of money that you can access that help you with capacity strengthening. And it's just a matter of doing some research. There's a lot more that are doing this, but mostly this would be private foundations that are interested and have been pushing for the ideas of unrestricted funding still, trust-based philanthropy, and all of those ones tend to be allies and understand that civil society organizations need capacity sharing along with project funding. But any other thoughts?
Maybe Chilande, I could quickly add. Thank you so much, Elsie, for those questions. These are like sector-wide questions that all organizations are currently looking at. The question on financial sustainability, I think you mentioned about operational costs. So I think this is the era of NGOs or existing NGOs, large INGOs, to figure out how to structure their financial sustainability, because the costs were very high. Previously, grants were unrestricted. We could structure our budgets how we wanted. But moving forward, the future of budgeting for projects to come have to be very stringent. So financial sustainability is one of the things that current programs are very keen on. Issues of indirect cost recoveries. Previously, if you used to bill a lot of things, make sure that you figure out sustainability from that angle. Then the other thing, I'll echo Chilande's comments, is that we still have pockets of available funding that is unrestricted. If you haven't invested in resource mobilization that is touching on, let's say, high net worth individuals, African philanthropy, you've seen Dangote. If you're African, you know Dangote has now gone fully into doing even blended finance, investment, local resource mobilization. So it is the time to invest your LC. If you have someone who does resource mobilization, they have to map out alternative financing models. They are not the traditional grants where you have someone who looks for open calls for proposal. Knock doors, go to foundations, go to trusts, as Philippa works in the impact investment, figure out how to partner with impact investment. So really, it's the time to open up your minds. Do not be in the fixed cocoon of where we used to look for calls for proposals and send them out, expecting to be awarded within 3 months or 6 months. It's the time now to open up your mind and look into more innovative ways. Over to you,
I think I'm just to add on few words. I think let me get some words from Mr. Mike, who said I think what is needed is mindset shift, where we just change our mindset. Because I think before the restricted funding made us do the status quo things, where our operation cost was so high. You'll find that even the salaries for staffs were so high. When you look at the budget and the what is going to operation cost was so much, such that even the donor sometimes will be wondering. I remember one time there's a proposal we did where the donor says, we're too expensive to do business with you, because look at just the directors' salaries and other people's salaries are so huge to the extent of what is going the community. So I think let's change the way we think. Once we change the way we think and move towards to see that things have changed and we have just to fundraise. The way we do it, we have to manage it. Thank you.
And I've given you some more examples on there. Being part of networks such as this and the one that's been offered to us on the network here by Esther, I think that's another way of us improving our capacities without spending a lot of money. Consultants and whatnot, that's a whole story and debate for one day. But, you know, there are others that do things a little bit differently that, you know, you charge, you know, for example, for us at Warande, we charge funders a premium so that we are able to do other cohort-based accelerator programs at no cost or very minimal cost is possible. So there are people trying. There are people who understand those dynamics and are trying to do this. But also there's hope in the sense that, like I said, some of the, I've just typed on there, some of the new ways we did some studies 2-3 years ago on cost efficiencies of working with local organizations that we presented to a lot of bilaterals through the OECD DAC mechanism. And we have seen progress now to where they are changing some of their policies to allow for, you know, the indirect cost recovery, those provisions to be trickled down to local organizations. Before you join a consortium, the INGO would have a provision, but the local organization does not have. So there's those kinds of changes are happening, not fast enough, still not sustainable. I think these are the new ways of resourcing ourselves for me, and I'm biased, of course, will take us further than still relying on some of these grants. They're great, but they should be an accelerator or a catalyst to something else. And some of these ideas here, I think, is the way in which we save ourselves or we save our communities. But folks, please allow me to close. This has been fantastic. And maybe if I ask one word, I don't know if you can manage panelists, one word that you think, what capability will organizations need most to remain financially resilient over the next decade? If you can try and make it one word.
For me, I think one more word is just mindset shift. Let's just change the way we do. Yes, let's just change the way we do things.
Taking that to the bank. Philippa?
So for me, it would be 3 or 4 words, but it's think sustainability.
We'll take think sustainability, think long term, think tomorrow.
Yes, exactly.
Pamela?
For me, it's one word: adaptability. Let's be very quick to adapt to the new reality.
Next time, let's have a session on AI and how it can help us with that adaptability and efficiency. Ladies and gentlemen, allow me to say a very big thank you. Fantastic panel. The richness of experience here is just so humbling. Thank you so much for everything. And thank you all for coming and sharing so generously. Allow me to wish you a fantastic rest of your day. Thank you for staying this long. I've ended the conversation, Esther. I'm sorry. I closed your house.
Thank you so much. Bye, everyone.
Bye.
Bye.
Bye, everyone.